Good morning, everyone, and welcome. This is Joe Scarice, your co-host and co-founder of this great podcast this morning, the Creative Birth Strategies podcast, here every Sunday morning, 9 a.m. Eastern Standard Time. We're going to get started here in just a few minutes. I'm really excited for this week. What a busy, busy holiday time. Really excited about some announcements we're going to be making going into 2025. But I'm going to do a quick share, of course, and get myself started here in just a few minutes. But very busy week with the market, presidential election, budgets, all kinds of things going on. It's kind of very exciting and yet mysterious going into 2025. You know, where the rates going, where the economy's going, where's housing going. It's just going to be electrifying going into 2025. And again, we'll have some announcements over the next few minutes. We're hovering close to our 90th episode, and we're in season two, and we're really pumping out the great podcasting efforts from our sponsors and our support. We wouldn't do it without them. Just doing some quick things here, just cleaning up a little bit. Give me a quick minute. So some updates. We have some great sponsors, of course. I want to go over that real quick. I want to thank Mr. Gerardell Perkins of Perkatech. He has been our social media architect, our pretty much our Oz in the equation to our podcast. You know, if it wasn't for him and our partnership and friendship, we wouldn't be here. Okay, so that's one thing, and you really want to sit down and have a one-on-one with him and how to, you know, capitalize on your social media. And then I want to thank MB Capital, where I'm a referral partner providing referral unsecured business lines of credit for real estate investors nationwide. We're really aligning on some great business right now with our clients and just getting them in front of a lot of opportunities and money, of course. And I'd like to thank Miss Linda Pelagas, who's been a great support individual to our events. She's with Realty 411. She provides a national publication as well as national events throughout the country for real estate professionals and services. And then I want to thank Lendmark Capital, where I'm a senior loan analyst providing asset-based lending nationwide, DSCR, fixed to rent, fixed to flip, new construction, single family through four family, multifamily, and mixed use advisory and strategy. And then I'd like to thank now my new affiliation with Elite Dealmakers, Jim Ingersoll out of Richmond, Virginia. We are now reopening events under his veil of deal makers. So we're lead deal makers in South Jersey, Philadelphia, soon to be Lehigh Valley, as well as North Jersey. So we're going to kind of take a approach of North and South Jersey, Lehigh Valley, and Philadelphia. We're going to have educational events every single month, providing consistent theme of education, networking, and strategy. And I think it's definitely something that's needed. I'm seeing a lack of good insight on masterminding and really helping people break barriers and having transformation. And I think by affiliating with elite deal makers, putting events together with them, also be collaborating on presenting in a lot of their events throughout the country as well. I'll be doing some flybys and drive-bys on some of the events throughout the country, providing insight and education on asset-based lending fundamentals. We have some great events starting off the new year as well. We had two fantastic holiday parties this past Thursday and Friday night. Thursday night, we were in Lehigh Valley. Friday night, we had one in Philadelphia. It was great. Everybody was networking, getting reconnected. Announcements were being made about what was going on into 2025. A lot of excitement. And then now we're opening up the North Jersey one, the Lehigh Valley, Philadelphia, South Jersey. We're going to be very solid in our marketing approaches. Yardell and I have been also digging deep with our social media team, putting out all our video clips on all the different social media buckets. Our blogs are going out. So, like the discussion we're having today, that's already been posted as an article on LinkedIn. You could find it on Facebook, Instagram, Threads, Alignable, all the different places where this article will be discussed and what we're going to be discussing today. So a lot of good content being pushed out. So the market, let's talk about the market. People are all very concerned about what's going on in the market today. We'll get a little update on that. Rates hovered around 7.4%, 7.04. Really, they didn't pay any attention to the Fed with their announcement with the quarter point clip on the rate. The Treasury is just rallying. It's a true bull market. I don't foresee rates coming down anytime soon in the first or second quarter drastically because of what has been transpired in the last 4 years with inflation, bloated government, fatty government. There's going to be a lot of restructuring first before we start seeing rates down in that 6% range or even high fives. I'm more concerned is we need to see values come down first before we see rates come down first. Because if the rates come down, the values are going to stay up, and that's another bad thing. We're starting to see some foreclosures, especially on the commercial office retail front, intensifying. So some concerns there. Job reports were okay. And some of the other reports that came out this past week was okay, not great, nothing to go crazy about. But there's definitely a concern about the reset of our real estate, and with rates and the outlook looking a little uncertain, we really need to pay attention to what's going on in our market, especially specifically know your market wherever you are, whether it's regional or local. You really need to become an expert in your space. So some information there. I usually pull articles from Mortgage News Dailies and post those up on a day-to-day basis. So follow me on either LinkedIn, Facebook, or the other social media buckets. We're always updating some insights. Some other market trends that I noticed that caught my eye this past week. Let's see here. One that caught my Zillow reveals 2024 most desirable cities. This is interesting. Number one, Manchester, New Hampshire. Number two, Rockford, Illinois. Number three, Stamford, Connecticut. Number four, Columbia, Maryland. Number five, Bridgeport, Connecticut. Number six, Allentown, Pennsylvania. Number seven, Peoria, Illinois. Number eight, New Haven, Connecticut. Number nine, Waterbury, Connecticut. And number 10, Sunnyvale, California. I do agree with a couple of these. I like New Hampshire. I like the Connecticut market. Little problems with landlord tenant laws there, but really good. I like Columbia, Maryland. It's somewhere in between Maryland and DC. Allentown, I'm telling you, I am so impressed with what they're doing there. They're bringing lights and restaurants back. When you bring lights and restaurants, you bring all the proper demographics to a successful renaissance to a city. I have to be quite impressed with Allentown at this point. Bethlehem's really nice. We're going to be holding our monthly event in Bethlehem starting in February. So, but I really love what's going on with Allentown. Allentown's had a bad run for a good amount of time since the 80s. It's kind of restructuring now. And but they spent millions on lighting up that entire downtown corridor. They brought a museum to the area. So I'm a real fan of that. I do like Stamford, Connecticut a lot. I think it's a little inflated. Manchester, New Hampshire, like I said, I like that. And Maryland, I like a lot too. There's some places that didn't catch that weren't there, but some other ones that kind of were in the bottom half there that caught my eye was like some Rio Rancho in New Mexico. I thought that was interesting. Fort Collins, Colorado, Cary, North Carolina. So again, some other opportunities there that Zillow kind of pointed out. And let's see here. There's any other article that caught my eye. Oh, quarter three commercial mortgage delinquencies are ramping up. Like I tell you, got to keep an eye on what's going on in the commercial space, how that will bleed into the residential space. All right, so let's get started with our discussion today. Real estate syndication, understanding syndications, like what is the deal? Like we see all these people pushing this agenda that's out there, and I see a lot of syndications in trouble because they really don't know how to underwrite. There's a lot of questionable individuals putting together these syndications toward real estate acquisition, primarily in the multifamily space, and you're starting to see a lot of them going sideways. I know of three that are not doing very well here in the Pennsylvania market, and they're all somehow interconnected. But understanding syndication fundamentals in real estate is essential for investors, sponsors, and anyone that looks to participate in the real estate market through collective investment vehicles. What is a real estate syndication? Real estate syndication is a process where multiple investors pool their funds to invest in a single property or portfolio of properties. This allows individuals to invest in large, more lucrative projects that would be difficult or impossible to finance on their own. But a lot of these syndicators really didn't evaluate rates. They underwrote just a very good market, didn't foresee anything going sideways, and they got caught with their pants down. So, some key players in the real estate syndication you need to keep in mind: one, the sponsor or the syndicator; two, the investors or the limited partners; three, the property manager, who's going to property manage out that asset. Types of real estate syndications: equity syndication and or debt syndication. And then the benefits of real estate syndication: diversification, access to larger deals, passive income, tax benefits. Some risks of challenges: risk of loss, illiquidity, dependence on the sponsor, and how to structure a real estate syndication: entity structure, the operating agreement, securities compliance. And I want to make sure it's very clear. I am not an attorney. I'm not a syndication attorney. We're talking about this from a 50-foot level. So anything I say, you need to go and talk to a responsible third party that's licensed and secured in this discussion. And the best practices for sponsors in syndication is clear communication, transparent accounting, and experience management. And the best practices for the investors is due diligence, clearly defined investment goals, and regular monitoring. By understanding the fundamentals of real estate syndication, investors and sponsors, it can navigate the complex world of collective real estate investing and making informed decisions to achieve their investment goals. But if you don't have appreciation and you don't have value adds and rates go up and you're using a rate of like 5% and suddenly it's 7%, you're upside down in your deal on the way out. So you really have to pencil your deals down smarter. And one of these weekend workshops is just not going to justify it. You need to entrench yourself in understanding the entire commercial space. It's so important. It's just not a gloss over at a weekend workshop. I'm not trying to knock them, but it's bullshit, to be honest with you. And I'm seeing a lot of people in trouble because of that fact. And that's why we're having this discussion today, because I have had a call with several people talking about the good and bad and ugly of what they're going through. So I'm going to talk about the cons of this, not the pros. You have limited control. There's fees all over the place. So you got to really see what you're doing. And you're really market dependency. Your returns can be influenced by market fluctuations and posing a risk factor for investors. This is very serious stuff. You're going to put $100,000 into something. I want to know the credibility of the people that are syndicating the deal. Okay. And I know three personally that are not having a good time with syndication. They were way over their pay grade. They're not very smart. And now you're starting to see cracks in the surface in what they're investing in. Okay. So you really need to pay attention as a real estate professional. I don't like to talk the negative, but I need to be observant to the market. So if somebody asks me, hey, listen, what's your thoughts on this type of syndication? I'm going to be like, listen, where's the property? What are you buying it at? What's the rehab cost? What's the after repair value? What's the DSCR in the market? What's the rental market? Is it a class C market? Is it a class B market? Are you taking the C to B? Does it have any mixed use to the property? Who's going to be that tenant or tenants? Is it under 30% where you could take it out on the Fannie or Freddie side? These are some very deep questions that you need to understand before you start throwing money at these syndicators that are telling you some great story. There's a lot of story. There's a lot of just fraud out there that you have to concern yourself with when it comes to syndication. I don't think it's done meaningfully, like it with true, like that's what they want to do. But eventually, what happens is these syndications go awry, and you have to concern yourself that they don't. You know what you know, and you know what you don't know. So my concern would be that they probably are not just understanding the issues, and then when the boat's leaking or sinking, now they're starting to lie because they don't have anything else to cover themselves up with. So you got to do your homework on the market, the property, the surrounding properties, the surrounding market, the neighborhoods. You got to take a deep dive approach, and you got to see the structure of that LLC and that syndication. Now we're going to have a discussion on this in, I think, March. We're going to have a syndication attorney come out and discuss this in Lehigh Valley because I think it's important. So I'm going right for the jugular and getting the right education in front of people because I think it's important because I'm not a syndication expert. I'm a lender. I know what I'm good at. I focus on that every day. I don't try to pivot here or there. So we're going to start off with a special guest. We haven't seen him in quite a while. Mr. Bob Cheswick, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion on understanding syndication fundamentals in real estate, and then give us an update on LLCs, what's going on in the market, because, I've known you, 14 years now?
Yeah, 14, going on 15 years it'll be in January because we met at that event in January 2010.
Exactly. So what's going on, Bob? Let's get an update with you.
Okay, so hi, I'm Bob Cheswick, president of Chespin Corporation, setting up LLCs and corporations for people. I'm not a lawyer, so I'm not here to give legal advice. Sorry for my prolonged absence, but between some technical difficulties with Clubhouse and just a lot of things going on in my personal life, I just have not had a lot of availability outside of working hours to get on here. So thank you, Joe, for reaching back out and kind of dragging me back onto the platform. It's been a while, and I'm glad to be back. So syndication, when looking at it from the entity standpoint, I had to do some homework to refresh myself on these because in the incorporation world, syndication means something totally different than in the real estate world. So when I was doing my homework, something I basically nice one there, Joe. By the way, thank you for the graphic there. The biggest issue with that I would see on my side is when you're looking at the structure of a syndication, pay very close attention to where you sit within the contract of that deal. Many syndications are set up as LLCs or as another entity type called LPs, limited partnerships. Now, it's very important to remember that if you are a limited partner, either in an LP or an LLC, to meet the IRS's definition and the legal definition of what most states will define as a limited partner, that means you are handing over the money and getting back and letting other people run the business. So again, the devil is in the details. You may be entitled to portions of the fee, the profits, but that might be reduced by fees. You've got to read that contract super carefully to see what your responsibilities are and what your ability is to cash out on in the unfortunate event that the deal goes sour. And state law does factor into that as well, because all 50 states have 50 different completely sets of rules. While they are substantially similar, there can be very big differences between how LLCs and LPs operate. And one other note, if your deal is in a series LP, now we've talked about series LLCs before, but series LP specifically, right now the only state that's authorizing those is the state of Delaware. So if your deal is in a series LP, you want that contract reviewed by a Delaware attorney because they're going to be the most familiar with how series LPs operate. And not all states, by the way, recognize the protections of a series LLC. So be careful with that as well. Now, as to what Joe had brought up, what's going on in the LLC world, back earlier this year, I was warning people about the addition of the Corporate Transparency Act, or the Beneficial Ownership Information Reports. The rules basically say that if you formed an LLC or corporation before calendar year 2024, you have to register by New Year's Day 2025 to avoid fines and penalties. Any business formed during calendar year 2024, you have to register within 90 days of the formation of the business. And starting next year, 2025 and later, you only have 30 days to register. And that includes disclosing information like your EIN, location of your business records, and photo IDs of all beneficial owners of the business. These are disclosed to FinCEN, which is a law enforcement agency of the U.S. Treasury. There's no cost to do it if you do it directly through FinCEN, but the filing requirements can be complicated for businesses with multiple partners. Now, very important to understand, a few weeks ago, a federal judge in Texas issued an injunction against enforcement of this law. So as of right now, you are not required to file anything unless the injunction is lifted. The federal government has appealed the injunction, and the Fifth Circuit Court of Appeals is expected to rule on it by December 27th. If they lift the injunction, you will have 4 days to comply. And the system crashing, which it keeps, FinCEN's system crashes. I won't even say periodically. I will say regularly. It goes down. That will not be an excuse to escape the $591 a day fine for delinquency. And there are criminal penalties that can go up to 2 years in federal prison for failure to file. So if you haven't filed this yet, you technically don't have to now. But if you do have to file and you don't, you can be fined or even imprisoned by the federal government because this is considered a national security law. So that's kind of where that's at. I don't want to hijack the whole room for that purpose. That's something I could talk about on a separate room or separate stage if there's enough interest. But that's the current comings and goings with LLCs. But back to the syndication thing again. Read the contract, read the operating agreement, read the partnership agreement. The devil is in the details. Joe, back to you.
Bob, thank you very much, and thank you for the update. I mean, we'll yet to see once Trump gets back in, the cabinet gets their footing, Doge kind of gets their hands wrapped around a couple things, and see what this all looks like. I'm concerned they pull the shower drape back and they don't like what they see, but we'll figure that out. They definitely need to thin out the government and make and take the bloat out and the pork out of there, you know. And syndication is going to get impacted by this. Like any investment avenue, real estate syndication comes with its set of advantages and drawbacks and then on the upside, it may present a number of benefits such as enhanced overall portfolio diversification, access to potentially advantage real estate deals, and the lure of potential passive investment. But on the flip side, it may pose challenges like limited control of the asset trajectory and extended investment horizons, among other considerations. We're going to explore the syndication pros and cons in a few minutes again and discuss due diligence for your upcoming, thoughts in syndication if something presents itself. We'll go next to ladies first, of course. Daphne, good morning and welcome. Brief overview, who you are, what you do, and thoughts to understanding syndication fundamentals in real estate.
Oh gosh, I hate these intros, but good morning and thank you for having me on the stage, Joseph. Always appreciate your space on Sundays. My name is Daphne Christine. I'm a lender and investor here in Charlotte, North Carolina, and I'm just getting into syndication. In 2025, I've hired an attorney and some other coaches on my team to make sure that I am making sure that there's all the T's and the I's and everything is crossed as I move into this next level of investing. So I'm just eager to partake in this conversation and see what I can learn from you fine folks this morning. Thanks for having me.
Thank you. And yeah, it's a very big learning experience. And there's a lot of people out there that are not licensed and not putting themselves in front of people that are licensed and educated in syndication. And things are not rolling out to the way that they're claiming they're going to. Like I know personally of individuals that don't have credit, don't have finances, and they have syndications and they're trying to attract money into deals. So like they're not even qualified to take the deal down at all. Like none. They can't buy bubble gum, but they're raising hundreds of thousands of dollars from others for their deals. And that makes me nervous because where is the exit strategy? Like, who's the personal guarantor on this loan? Like, who did you suck into this deal? Like, if your credit's crap, you obviously misevaluated something at one time or another. Like, why are you the leader of this ship? Are you driving the Titanic and identifying glaciers to crash into? So I'm always concerned when I see that. I have to stay quiet because I know too much of some people, and I have to kind of say, hey, maybe you might want to look at other options other than that one, or consider other options. I can't just say, hey, listen, they really don't know what they're doing, and maybe you should look something else. Maybe you should put your money in a CD. So, it's all about the control of the deal. Okay. And how are they identifying this investment? Okay. I had a discussion with somebody on the acquisition of a multifamily building. They were trying to raise a lot of money on the equity side. And I'm like, why are you trying to raise so much money on the equity side and trying to do the repairs yourself when any bridge lender in the world will give you 100% of the renovations if it makes sense and justifies the value add to the property? And they just looked at me like I was like a lunatic. I mean, like, and everybody just started taking notes in the event and saying, I'm like, why wouldn't you leverage 85% on the purchase of these properties? And then two, I'm looking up the property right now. It's not a multifamily. It's a bunch of 4 units. It's not actually a true multifamily. So really, you could get probably 85% leverage on the purchase of the property overall and do it more like a blanket loan and then get 100% of construction. Then all that money you raised is left out there for contingencies, or you might be able to give them some money back in return quicker as you turn over the properties and readjust the income and readjust the values by value adding the roofs, the interiors, or exteriors. And they just looked at me like I was out of my mind. And I'm like, listen, are you guys, where do you guys work? Like, are you underwriters or do you work for a Fannie or Freddie lender? No, no, we took courses and we're educated and we spent thousands of dollars on insight. I said, was there anybody licensed in this syndication discussion? Did they have a syndication attorney in the course giving you the good, the bad, and the ugly of what it looks like and where your exposure is? And did they educate you on debt and equity? And did they educate you on a value add bridge lending where we welcome syndications? Like I welcome a syndicator in the bridge lending space. They understand that you got to have some money in the purchase. They understand they're going to have renovation money being provided to them as long as the numbers pan out. I'm working on one right now. It's a 146 unit conversion from hotel to Section 8 housing. And the numbers make sense based on the market area, justifies Section 8. So you really need to pay attention to what's going on every single deal. Can anybody hear me? Hello? 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 Can everybody hear me? Hello? Hello? Can everybody hear me? Yep. Hello? Can everybody hear me? We're having a malfunction here. Hold on one second here. Give me one second. See if this works. Having a little problem with our podcast here right now. Hello? I'm gonna temporarily give me a minute and I'm gonna go back in. Give me 1 second. This is a little catastrophe, but we'll get through it. Give me 1 minute on this podcast. Hold on 1 second. Hello? Can everybody hear me? Can anybody hear me? Hello? No.
Bluetooth is on. Turn your Bluetooth off. It's on.
Why is my car?
Not your car. The landlord.
Turn it off.
It is off. Turn your Bluetooth off.
I don't know how to do that. So
I'll help you.
sorry, guys. Give us a minute here. We got a little difficult. Yeah.
Settings. Settings.
Stop. We're back, guys, I think. Give me a minute. Hey, we're back? Everybody gonna hear
Yeah,
me?
we hear you now, Joe.
Oh my goodness. I don't know what the hell happened. My phone went to Bluetooth.
Like you're either boarding a train or got in a car accident. Right.
Yeah, well, that happens in my world. Sorry about that, guys. So we're back talking about syndication. Apologize about that, but yeah, we have a little. We'll just keep moving along here. Where did we end off last?
I think you were just kind of going over. I forget what you were going over actually, but you were talking.
Unbelievable. So sorry about that, guys. So let's talk about get back to syndication. Steve, good morning and welcome. Brief overview, who you are, what you do, and let's discuss understanding syndication fundamentals in real estate. Steve? Now we lost Steve. Bob, are you there?
Yeah, I'm still here. Steve's silent. I don't know if he realized you got Steven, exit and enter the room again. That might bring you back.
Well, we'll skip Steve for now. He'll text me when he's available. Justin, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion, understanding syndication fundamentals in real estate.
Good morning, Justin Jefferson, in Baton Rouge, Louisiana, Southern Louisiana market. Done a bunch of things. I'm not a syndicator. I have raised capital for my smaller deals and so on and so forth. But to my understanding, over the past several years, obviously the deals you'll be investing in with a syndication are typically your 1 year turnaround. They usually going to last at a minimum 2 years, 3 to 10 years, and beyond. So you look at the investment stuff in the long term. It's a really more of a sophisticated deal from the ones that I've seen structured, usually around multifamily or a set of commercial investment, etc. So my thing is always get this one of get a lot of legal and to do that. I would also recommend being relatively familiar with whatever investment it is to share the risk with. Things I think, like I said, you want to be aware of, and so just being aware of the financial climate. This is be a return on your money based on a risk you're taking in a particular market. So there are 3 or 4 layers where risk is involved, where there's a set of risk involved, right? With each one of those. So you just want to be aware of that as well. And I think the most important thing would be the track record of the syndicator. We all want to help our friends. We all want to, help somebody get on to a good start. If you're not an expert in it, I would recommend getting with expert syndicators, people who've been maybe even second generation syndicators, right? Companies, right, that are on their second generation, or not even that, just somebody who has at least 15 or so years of experience, enough time to be on both ends of a cycle. So I think that just from every testimony that I've heard over the past couple of years, it's been a hot topic it's been about a year since it's been a major topic, but before that, it was a pretty common conversation. There were a lot of deep dives in it. So just from what I'm saying, those are my thoughts on that.
Yeah, you got to find the right property. You got to research the market. You got to run the numbers. You got to put together a syndication. That's going to cost anywhere between $5,000 and $10,000 if you're going to do it yourself. Then you got to identify the limited partners. You got to identify the personal guarantor. You got to then negotiate terms on an investment or a subject property, structure the deal, identify a lender that's going to obviously structure and recognize the syndication and who the guarantor is, and then close the deal. They make it sound so easy at these workshops. My concern is that they're not giving you enough information. They're giving you enough information to get you in trouble. And most of them that are offering these workshops are looking for you to give them your money instead of you going out and doing your own syndication. You know, how do syndications make money is in the value add and the appreciation and the payout for the limited partner that puts it together and getting their name recognized in a deal. Okay. I think that's good. I like the idea. My idea of a syndication is find an experienced borrower that needs a little money to put down on a property, right? And take a 5 or 10% ownership in their LLC based on the equity participation into the deal. And you're just a limited individual in the ownership of the property. And I don't think there's much difference in it. You just have to structure it correctly with the operating agreement, but you still get the same recognition of ownership in a multifamily transaction, whether it was a value add or a turnkey DSCR or cap rate play on a property. And then you could take that, and then now you get recognized with experience to lenders. So I mean, you got to remember the most important questions a lender wants to ask is the guarantor. How many rehabs for rental have you bought? How many rentals have you bought in the last 8 years? Those are two very important questions. That is going to categorize you from an A plus borrower to a D plus borrower. Okay. If you have zero of those, you have no experience, which is fine, but the buy-in is going to be much heavier for you. But if you have somebody that has, I call them the gray hair person, right? They have the experience, they have the longevity in the business. I'll give you an example. I recently spoke with someone that has probably close to $10 million of free and clear mixed use buildings in a very specific market. And now they want to collateralize those properties, create a fund, and identify single family through four family and buy properties within that fund. And they want to kind of pop in and out on that money and just go aggressively after portfolios, refurbish them, throw them into Section 8, manage them out, and just make 2 to 3% on their money every month, up and above what they're making also on the current properties. I think it's a great idea because I love the market where they're in. They're very experienced. They're a construction outfit. They have management in place. They have all the subs that can get in there to turn properties over. The question is there inventory to do this? Is there enough properties to take 2 million and leverage that at 10% down on a property, on a purchase, and somebody providing 100% construction to keep them busy with that money? How many times can they turn over that money? If you're just buying one multifamily and there's mistakes made or management doesn't facilitate the property correctly, what is the end result to that asset? I mean, you're expecting to make double-digit return on putting your money into a syndication. And then when it comes time, you're getting only small single digits because somebody did not calculate the income and expense correctly. They didn't calculate the rate correctly. They didn't calculate the value add component to the after repair value or the current value of the property. Stephen, are you there? Brief overview, who you are, what you do, and thoughts to the discussion. Understanding syndication fundamentals in real estate. Still can't hear you, Steve. Steve is silent, Steve. Can't hear you. Bob, can you hear him? Bob going once? Bob going twice. Justin, can you hear him?
No, I can't hear him at all.
So we'll try to get back to Steve in a minute. But Bob, what's your additional thoughts to our discussion here?
Just listening to what it comes down to, it like I said, I don't do real estate syndications myself, but just listening to the issues that pop up, it's like I said, coming back to looking at how these deals are structured. I see day in, day out people that are setting up either real estate holding LLCs. Obviously, they're not syndicating, but they're partners going in, or just even other types of business deals that are very similar. And again, the whole thing comes down to what's written into these contracts. I just had a customer that went, shall we say, pie in the sky a couple months ago and formed a ton of companies because they were going to get into some big deal. It wasn't real estate related, but the same idea that they were going to have all this money flowing in and everything. And a couple weeks ago, they emailed me saying, well, the deals fell apart. Is there any way I can get my money back? No, that doesn't work that way. So once you set up the company, you're stuck with it and you have to pay to shut it down. That's how it works. But again, my biggest concerns with it is the devil's in the details. But in particular, also, if the Corporate Transparency Act does come back into play, if the injunction's lifted, or if eventually the U.S. Supreme Court's going to get involved, be mindful that based on your role in the business and or the amount of money that you're putting in on the syndication, you might be considered a beneficial owner for the purposes of reporting to the CTA, and you can be personally fined or jailed if you don't submit the information, which is going to include photo IDs and all that. So you pay extra attention, and honestly, have an attorney review, your own personal attorney, not theirs, review the syndication contract before you get into it, especially if CTA, the Corporate Transparency Act, comes back into play, because you may have unexpected legal obligations to that the GPs might not be following through on. So be careful with the syndication deal. The Corporate Transparency Act definitely put a wrinkle in it. I would not be personally surprised to see this thing go away, but then again, inside of the DC Beltway, anything can happen. But again, the devil's in the details, and also just make sure that if you're involved, that you're not classified as a beneficial owner in accordance with the Corporate Transparency Act rules. And by the way, beneficial owner definition for the Corporate Transparency Act is not the same as it is for state or IRS rules. They are two completely different definitions. Go back to you.
Yeah, so for the majority of investments, when you factor in profits from a sale, after a 3 to 5 year projected hold time, that's what syndications usually are. You're supposed to see 15 to 20% return on your money, right? If it's not being invested correctly and carrying the risk of market fluctuations and management and unexpected economic events, a lot of these guys and gals that are in syndications, they don't come from a Wall Street background. They don't have Wall Street background. None of them have a resume that they were on Wall Street. None of them worked for a capital group. None of them did analysis or audit or underwrite. They took a course, maybe a couple courses. They did a couple of these kumbaya events where they paid 20 grand to go hold hands and talk about their opportunities in real estate. And at the end of the day, there's no depth in insight on a market, understanding economic turns, understanding rate fluctuations, understanding the treasury, understanding regional impact to the where the property is, the asset. Buying low and making money on the high doesn't always work in some markets. Are there jobs coming into that market? Is there a concern about crime? Or have you done crime reports on the properties or the locations? We're starting to see more underwrite on crime reports just because people there's not enough inventory in better markets, so they're going into worse markets and taking heavier risk. Rehabs are heavier. Is that value add makes sense to the market, right? So I don't know, putting granite countertops in a certain market compared to laminate countertops, is there any difference in the rent? Does it change anything? Okay, if you have laundry centers and elevators and a community center to the multifamily, coffee every morning, what does that do to what type of demographic are you attracting, right? Like I was recently down in Fort Lauderdale not too long ago, and I was staying in the area where it kind of used to be kind of the hoodie area. And now they're restructuring, putting these beautiful eat, work, and live malls and eateries. Now, it's going to bring the people over there. Okay, this is for the last 20 years. This was the worst area for Fort Lauderdale, and now it's going to be this nicer area, not too far away from the Hard Rock Casino. Who's going to be living in there? Like, what's the demographics of it? Is it 25 to 35? Is it 55 plus? They're trying to do something right now in the Atlantic City market, right? If you bring lights, you bring people, you bring restaurants, you bring people. It's along the waterfront. You got this $1 million promenade with just empty land in front of it. Eventually, somebody's going to take the risk and bypass the idea of the concerns of crime and push that out of the way and bring multifamily developments with restaurants. They've done it in Long Branch, New Jersey. They've done it in Asbury Park. If anybody has ever been to Asbury Park, it's an amazing transition of what they've done leveraging the shore. And they kind of just push the crime out of the way. Now, is there still crime there? Yes. You got to keep your eyes wide open. Yes. But is there definitely appreciation and stable environments there? Yeah. Are they good investments now? No, you kind of missed that window. So you got to find that next value add opportunity that presents itself. I'm going to come back to Daphne real quick. Daphne, any additional thoughts to our discussion or statements in regards to understanding syndication fundamentals in real estate?
No, this has been really valuable. I just appreciate being part of the conversation. Thank you.
My pleasure. So let's try to see if Steven is back. We had a couple mishaps this morning. This is Joe Scarice, founder and co-host of the Creative Birth Strategies podcast. So hopefully we'll have some normalcy here for the next little bit. Steve, are you there with us? Steve, we cannot hear you at all. Steve is out of commission for the time being, but we appreciate his presence. There's something definitely going on with your sounding board there. Justin, some thoughts to understanding syndication fundamentals in real estate. Am I saying anything that's out of sorts that you haven't heard before or at least thought of?
No, not at all. And I think it's, like you said, it's kind of important to lean into, their experience. So, and just what's going on in the market. If you don't know the basics yourself, I think it's really tough. And then putting all of that faith into somebody else, it's a big risk. It's a big risk to take. And in my opinion, more sizable, closer to you investments are a much better way to, first of all, probably get a better return on your investment, and increase your chances of actually getting what you expect out of the deal. So,
do some homework, like Justin's saying, like check out your top 5 real estate syndication companies to consider, just to look at and see what they're offering and what they're extending. Have you ever heard of Fundrise? Have you ever heard of CrowdStreet? Have you ever heard of Equity Multiple, Yield Street, or Realty Mogul? I mean, Fundrise has been around a while. I mean, look in what they're saying. I'm not saying invest into them, but do your research. I mean, this is a very speculative part of the market. Like when you're providing one of maybe $100,000 deposits or $50,000 deposits or $25,000 deposits into an asset that you don't control. Other parties control this. So there's some disadvantage. You don't control the steering wheel. You don't even control the gas pedal. So there's a lot of consideration of you got to spend money, right? It's not on a course. I would first retain an attorney in the syndication space and sit down and pay time to have time consultation with them. I think that's way more valuable than taking a course with somebody that's really just trying to obtain your money. Like, I mean, how much could it cost to sit down with a syndication attorney? What they charge? $300-400 an hour? So if you spend $2,000 with 2 to 3 hours with them, do you think you're going to get a lot more benefits and understand contractual agreements and the relationship between personal guarantor, the GP, the limited partnership, the asset itself? What should I consider? What are the successful syndication thresholds? What should be my buy-in? What should I be looking for in the individuals that are putting together the syndication? As we go through economic changes, which we will, okay, there's going to be shifts in the market in 2025. I feel your malls, your office retail, commercial buildings are going to have massive shifts. And how does that bleed into the multifamily space? And then how does that bleed into single family through 4 family space? What does that do to rental comps? What does that do to the comps in the market? What does that do to cap rate? What does that do to DSCR? Like, how does that all evolve when there's so much more money into the market in the asset-based lending space compare to where it was in 2008? We're going to do one more try with Stephen. Stephen, good morning and welcome. Brief overview who you are, what you do, and understanding syndication fundamentals in real estate.
Sorry.
Yep, we can hear you fine.
Okay. That was weird. Restarting 7 times this term. All right. So real quick, I am not experienced this space too much. I've been looking at some syndications over the last couple of years, and we're probably doing a self-storage one coming up in the spring. My team finding the property and so on and so forth. And basically what I've discovered is that the level of research and the level of knowledge and the different terms and way they use the terms can get me lost real quick. I've been doing small multifamily for a while, and really it comes down to now reach out to your team. Get the right syndication attorney, get somebody like a Joe or somebody else experienced in understanding these terms. Get some people on your side to help you understand. And don't necessarily, if you did take a course like I did in self-storage, if you took a course, don't necessarily let your coach be the be-all and end-all of the answers. Bring in your own people, because a lot of those course coaches get a piece of the syndication, and that immediately kind of taints their position on what they're offering you. So bring in your team, get your team. For me and my partners, we actually met last night and agreed that we've been doing real estate for a long time, but we need help, because these terms and the way they lay out these terms and how we should lay out these terms, we need a team to put it together for us or with us, or to review somebody else's put together. Because there are so many ways that you can get hurt, or you can dig yourself a liability hole. So I think team is about all I've learned so far.
You know, some mistakes that can occur when syndicating real estate, and this is tied into what Steve's saying: hiring the wrong attorney, paying or accepting commissions, too many managers, too many spoons in the soup, closing without enough capital. I've seen that before. Chasing whales and not having a coach. And I saw somebody post, "Hey, who would be the best coach for you? Like, I need a coach. I want to transform in 2025." And some guy put Tony Robbins. I've been to Tony Robbins courses, and it's great temporarily, but you need a local ground floor coach or mentor, right? That the whole whale concept, it doesn't work here. Okay, Tony Robbins is not going to be around for you every week or every couple of weeks to have a discussion, to have an open discussion. Hanging out with smarter people than you is the first thing. Like, I'll give you an example. I had an option to go to a complimentary event Monday night, or an event I got to pay $150 to go to. Who do you think is going to have better caliber of people at which event do you think? You think the place where I'm paying $150 to walk in the door? Yeah. Are there events for lenders where you're hanging out with smarter people than you? Yes. It's $1,500 to $2,000 to walk in the door. The ones that are free are garbage, or the ones that are below $1,000 are garbage. If you're not spending at least $1,000 to $2,000 to walk into a lending expert room, you're not in the right room. You got to be in the right room. You got to figure out, you want to be in the right place with real estate syndication. You want to hang out with an attorney that knows that and see what they've done in syndication. It shouldn't be their first syndication structuring. You know, I want to take a step back, because we have a great educational event coming up January 11th, and it costs nothing for you to attend, but what it does cost you is your time throughout the day to teach you how to underwrite deals from a lender perspective. I'm going to share my underwriting tools for you to price loans out, whether it's a single family through four family, whether it's a multifamily building, whether it's new construction, whether it's fixed to rent, fixed to flip. It's January 11th in Philadelphia, and we're going to dive into underwriting deals for you to price out for yourself or others. We're going to teach you what white label marketing is, right? We're going to make you the better real estate investor. The better real estate investor knows how to structure their own deal out and price their own loan out. When you're at that level, there's not a lot of other people you need to depend upon. So I've put together this course. It's also CE credited for any licensed real estate agents. It's 3 credits in almost every state except a couple that are only 2 credits. I wrote the module, so I'm published with it. I teach it at Temple University in Philadelphia, and I teach it at Rutgers Newark University in New Jersey. And I think, we're going to have some really smart people in that room. We're going to talk about how to structure the deal, how to understand how to underwrite the deal, what is the current pricing in the market, what's your leverage allowability based on experience or inexperience, how to structure that LLC to make sure it works. Because syndications are going to be successful when money is getting tighter, but they're only as successful as the power team that's put together in place. And you want to be one of the smartest people around. Now, you don't want to be the smartest person in a room of a syndication because now you don't have as many smart people helping you get to the starting line on a good deal. I think you have to have concerns about who the attorney is, who the limited partners are, who the general partner is, where their experience level is, doesn't match with the asset that you're putting your money into. Should you be the general partner? What does that look like? And what are you looking for? What should you be requesting as a general partner? What do you think a general partner should ask for to manage out and have their neck on the guillotine on a deal? You got to think about all this. This is just a 60-minute with a couple little problems this morning. A 60-minute discussion on the idea of real estate syndication, just fundamentals, the good, the bad, and the ugly. And there's a lot of more bad and ugly right now than good, because I think a lot of people got into it with being poorly instructed, and now they're trying to figure how to get out of some of these things, or they're not seeing returns. I mean, we hear about this all the time on a national level, whether it's one of the big time guys or gals or the smaller level. You find that there's problematic issues in all levels when it comes to syndication. And at the end of the day, sometimes you're just better off buying a single family home and just getting yourself started. If you have 100 grand, I don't really think, and that's all the money you have toward a deal. I'd keep that in your pocket and make sure your credit's above 700 and go identify a couple smaller deals and just get your experience and just understanding how to get through a process of a renovation and stabilizing a property, and identify a mentor for that. Retaining a general contractor, not thinking they're going to work for you for free, retaining them, retaining an attorney and putting them on retainer, right? Having your CPA on retainer, spend money that way, because now you have their utmost attention to whatever you're trying to talk to a CPA as well as an attorney when it comes to syndication and get their take on what the tax impact is on syndication that's going to impact your bottom line. If you obviously have 100 grand to put into something, you earned that 100 grand. It wasn't something that just kind of like popped up in your bank account. And I see somebody saying about publicly traded REITs. Yeah, again, you still have to do your homework. REITs, big time REITs make mistakes too. They under or overvaluate a deal. I've seen many mistakes. I've seen many portfolios being traded at discount that REITs bought and had to sell to another hedge fund because they got caught with their pants down. People make mistakes all the time. You just want to lessen the risk for yourself because your money is your money. You earned it. You put it in your bank account. You want to make sure you're making a return on your time and your money. It's very, very important. I think this is a great discussion. I think we covered a lot of trail on at least opening the possibility of syndication and understanding it, doing your homework. So I want to thank our sponsors, of course. I want to thank Elite Deal Makers, where we're going to be in South Jersey, North Jersey, Lehigh Valley, and Philadelphia, probably all by March of 2025, providing educational discussions. And I will bring a syndication attorney out at every one of those to have this type of discussion live in person. I want to thank the Realty 4-in-1, Miss Linda Pelagas. I want to thank MB Capital, we're a referral partner. I want to thank also Lendmark Capital, where I'm a asset-based lender nationwide, providing white label marketing for brokers and correspondents. I'm also providing insight and advisory and DSCR, fixed to rent, fixed to flip, new construction, multifamily, mixed use for investors as well. We do have a white label course coming up January 11th. Very excited about that opportunity here in Philadelphia. If you are going to come in, you're going to come in on a Friday night. We're probably going to grab a little happy hour somewhere local to where we're having the course. So please reach out to me if you are making arrangements to fly in into Philadelphia. We're probably only about 15 minutes away from the airport. So I'm very excited about what's coming. We're going with the podcast and what we're going with the events and education, the social media platform. I want to thank Yardell Perkins, of course, at Perkatech, who provides all this video content. You're probably seeing a lot more video content on Facebook and LinkedIn on our platforms. If I can set up an interview with you and have a one-on-one and help you build out your business, let's discuss that. We're doing some more one-on-one podcasts going into 2025. We'll be here every Sunday morning, 9 a.m. Eastern Standard Time, for a solid hour of education, insight, and strategy. And my quote this morning: do everything with a good heart, expect nothing in return, and you will never be disappointed. Everybody have a great week. We're going to have a special Christmas podcast, Christmas morning, 9 a.m. to 10 a.m. And then we'll be back again Sunday morning, 9 a.m. So if anybody's around on Christmas, we'll get to celebrate a little bit for about a half hour, 45 minutes on another great discussion. And I'll be ending the room in the next 30 seconds. Have a great day, guys, and take care of yourself.